Wall Street's rally to be tested as earnings season approaches. Welcome to Market Insights, I'm Peter Devlin. With a new week underway, third quarter earnings season is now coming into view. Bullish investors are hoping results will justify increasingly rich valuations in a near US stock market near record highs. The S&P 500 is up 20% year to date and stands near record highs. Will companies post healthy enough profits to sustain the rally? Well, joining me now to talk about all that is Eric Lynch, Managing Director at Scharf Investments. Welcome, Eric. Thank you very much for joining us. So the S&P 500 companies overall are expected to have increased Q3 earnings by 5.3%, as from a year earlier, according to LSEG estimates. So that forecast has been dropping. Do you expect weakness this earnings season?
I actually think we're going to have a stronger than expected earnings season, Peter. Reason why is if you look at the fact that 3 months ago, the expectations for Q3 earnings were going to be 8% year-over-year growth. We're down to 5, as you mentioned. A lot of that discount was consternation associated with the economic prints that had weakened throughout the summer. But recently, we've seen a strong uptick. Last week, we had the non-farm payrolls really decimate expectations, up 250 over 150 estimates, increased revisions for the prior 2 months. And then we also, I think a lot of investors probably didn't really notice that the ISM services metric was huge, 54.9 versus a 51.7 estimate. That's the highest reading, Peter, we've had since February of 2023. Since 70% of the economy is services, that's a big deal.
So with those lowered projections for earnings as well, has the bar overall been lowered for companies to exceed those expectations?
Yeah, traditionally, corporations do ultimately exceed expectations because they do, in fact, lower that bar. If you look at Q2, we had strong 11% year-over-year earnings growth. What was really intriguing about Q2, the most recent earnings season, was that it wasn't just IT and Max 7 led. There were several sectors that grew their earnings in the teens, including financials up 18% year-over-year earnings, and healthcare up 17, just behind IT at 19. So if that broad trend continues, and we saw it in returns in Q3 as well, if that continues, Peter, into the Q3 earnings season, then this market that's already kind of transitioned away from IT and Mag 7, very broad-based. Actually, more companies individually are outperforming the S&P 500 in the recent months than they have in 30 years, because you're seeing this broad-based recovery. So this earnings season is critical to see if that earnings broadening that would support that return broadening will continue.
So Eric, let's jump to Friday for the big banks reporting. You said in your notes that JP Morgan investors will be paying more attention to the lender's outlook than the results. So what particularly are you looking for?
Sure. Well, the 50 basis points Fed cut was great for banks, obviously. Hopefully, it will instigate more loan activity and increase their net interest margins. Probably you're not going to see any impact in Q3 or even potentially Q4 outlook yet, Peter. But we'll see if the bank can give us more guidance. Banks in general can give us more guidance as we head out to 2025. So what we're going to be looking for are kind of 3 things. One is net interest margin, which, by the way, JP Morgan guided down on September 10th, and the stock's been down since then. But we'll also be looking at loan activity, more importantly, that demand. Finally, at credit provisionings for losses. In the last quarter for JP Morgan, Q2, year-over-year provisions increased about 30%. So if that trend continues, that'll certainly be bad for JP Morgan and other banks. We'll see. The banks are really a microcosm of what we're looking for in terms of the economy in general.
So finally, Eric, and Goldman Sachs, they've upgraded their S&P 500 forecast for a third time today. They're now expecting the index to reach 6,000 in 3 months' time. Do you think this is a realistic target with earnings season ahead?
It is realistic, Peter, if earnings can continue broadening out and if companies are generally outperforming this 5% consensus estimates. Yeah, we're not that far away from it. Yes, the multiple writ large on the S&P 500 is around 23, 24 times earnings. That's very expensive. But if you look at the equal weight S&P 500, which takes the average stock and removes the distortion created by these expensive kind of Mag 7 IT type names, then you're looking at really close to an 18, 19 multiple, which is not so ridiculous, certainly if earnings are going to do what they did in Q2 and grow 10, 11% actually, or even high single digits.
Eric Lynch at Scharf Investments. Thank you very much for your thoughts. And that's Market Insights. Don't forget you can watch more videos on Reuters.com.